variances on the off diagonal, so on. Okay? But nobody tells us exactly what these are. We have to estimate all these things, right? That's the problem in portfolio mathematics, in applying portfolio mathematics. Huge problem, okay? What can go wrong if some of these are poorly estimated? Yeah, efficient portfolio will be shifted, right? Optimal portfolio may not be on the efficient frontier, that's true. The so-called optimal portfolio. So, but the problem is that if we have these securities and we misestimate the risk, or we misestimate the correlation between the securities, we're not going to get the proper equations here. We're not going to get the proper Sharpe ratio here, right? And we're not going to do, when we do a maximization operation, the mathematics are fine, but the parameters are not fine. Particularly this, which depends on this, right? So basically just about anything can happen. I mean, a bad covariance matrix, and you invert it, basically what's going to happen, the way I would say it, is that those securities that have an underestimated covariance with other securities, or have an underestimated standard deviation, I should be pointing over here. Those securities that have an underestimated variance, or have an underestimated correlation, covariance, I'm sorry, with other securities, will be upweighted in the optimization procedure. And this will be an error, okay? Because these are badly estimated. These are underestimated. The ones that will be overestimated, because you think about 1 over everything, something, if this is my weights, then 1 over it causes trouble when these things are near 0, or if they're way too big. Okay, if they're near 0, it's going to blow up the weight. If they're too big, it's going to make the weight too small, right? That's just kind of an intuitive way to think about it. This is kind of a 1 over covariance matrix type of situation. Make sense? Make sense? Thank you. Yeah, but I mean, in essence, you guys, I think, said this, most of you, is you're going to get the wrong efficient frontier. Yep. Okay, okay. Pretty good. I think you actually did better on number 3 than you did on number 2. Okay. So that gives me some hope. Okay, so let's go on. So that was fun. That was fun. I'll give you little pop quizzes every now and then to test your abilities. Oops. Okay, so let's move on. Okay, so if the CAPM is correct, that's our equation. Okay, is there a graph that we can write down? Is there a graph that we can write down to represent this equation? What is that graph? Is there a graph that we can put down to represent that equation in graphical form? Sorry? Okay, but what's on the y-axis first? You're getting ahead of me. What's on the y-axis? Okay, so we can do that, clearly. No trouble with the markers today. Okay, I can do that if I put expected return as the y-axis, okay? And the way I wrote this was excess return, expected excess return. So this is expected excess return. And on the x-axis I put, what? Beta, right? Beta. Right? Right? Okay. So we can treat the beta as the x variable, the y variable is expected return, And then what kind of a relationship do we get? We get supposedly a straight line, right? A straight line. And since this is expected excess return, it should emanate from 0, right? Okay? And what is a slope? Sorry? No, not beta. We use beta in the x-axis. Yeah, it's a risk premium on the market. Okay, when you're thinking of putting RM or F on here, that's the graph you would use to find the beta of a security or something. But now we have the beta. Okay, so now we just want to plot this in a sensible way. We want reward up here. We want systematic risk down here instead of total risk. Okay, right before we did. Oh, let me just put it on here. Before we had excess return on the y-axis, but we had sigma on the x-axis, right? And we had this kind of relationship. Okay, now we have a straight line relationship. And once we transfer over to using systematic risk measurement only. Okay? Again, this is just refreshing, because this will be refreshing your memory about what we learned in financial theory, because this is going to be important in understanding what comes next. Okay, but everybody's on board with this? What do we call this? Just CFA question? What is that line called? CFA test question? No? 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 Problem error CFA questions. What is that line called? This line right here. What is this line called in portfolio theory? Securities market line. SML, right? Did you have that? We need to speak up then. SML, okay? Okay, you gotta know all this stuff, okay, to be in finance. These are just the very basics of finance. No matter if you're corporate finance and investments, a banker, these are just fundamental things in finance, okay? All right, so let me stop hammering away at you, and let's start moving forward with this. Okay, I told you about the limitation of the CAPM. Can anybody tell me one or two of the limitations of the CAPM from earlier this morning? Can somebody cite one limitation or one assumption? Perfect market. What does perfect markets mean, though? Efficient markets that already have the same information. This is what I would call perfect markets. Yeah, there's no price pressure from trading, a bunch of other stuff, okay? So I said that essentially most of those assumptions, maybe all of those assumptions are right here, okay, are false. And so what the theory people did, what the academics did, was they tried to extend the CAPM model to, in several ways, to address these shortfalls, okay, shortcomings. For example, Merton's CAPM, intertemporal CAPM, addressed the idea that an investor will invest for multiple periods for their lifetime, not just one period. That's what the intertemporal CAPM is all about. Let me see. Oh, and I just say the rest can be found in any textbook. But yeah, Elton et al., Elton and Gruber's textbook does a pretty good job of laying out these alternatives. So there's a CAPM with taxes. There's the ICAPM. There's CAPM with trading costs. So many people have worked on these extensions on the CAPM to try to make the CAPM more bulletproof to these bad assumptions. But unfortunately, they've maybe fixed one assumption at a time. ICAPM fixes one assumption. The CAPM with taxes fixes a different assumption. You won't find a model that fixes all the assumptions, okay? So in essence, we don't know, whether the CAPM actually works, because we don't know the impact of all those assumptions together with each other. And we don't know if there's some force in the marketplace that overwhelms these bad assumptions and makes market prices come to be purely efficient and purely consistent with the CAPM model. How many factors does the CAPM have? How many risk factors does the CAPM have? one. Should be a very simple question for you. One risk factor. What's the risk factor? The return on the market, right? Or the return on the market minus risk-free is a risk factor. Okay? Single risk factor. For that to be true, all those things up there have to be true, and more. Okay? So, again, we don't know if those things are true or not. We think that they're pretty bad assumptions, but we don't know if there's some other force in the marketplace that overcomes those assumptions. But there's a lot of empirical evidence out there that indicates that those assumptions are pretty bad and that nothing really overcomes them in the real marketplace. So after this estimating the CAPM, which you can skip, okay. So here I talked a bit about efficient markets, and I think I studied, okay, so here's where I wanted to go to, is studies that attack the CAPM. Okay, so the CAPM was introduced in 1964 by William Sharpe. Okay, I also know this guy, and he's still very active as well. Since 1964, and especially in the 1970s and 1980s, there were a lot of studies that criticized the CAPM, that tried to beat up the CAPM and show that it was wrong. These studies did not necessarily come up with a better model, but their goal was to show that the CAPM didn't work. Okay? Maybe the most famous one was a study by Rolf Banz in 1981. And what Rolf Banz did can be drawn on this graph. Okay? He did it using equations and statistics and regression techniques. Essentially what he did was he estimated the expected return, expected excess return for each stock in the stock market, and he estimated the beta using econometric techniques, and then he graphed on this risk-reward diagram, on this reward systematic risk diagram, he graphed stocks, each individual stock, okay? And here's what he found roughly, is that okay, there's nothing wrong with this. There's nothing wrong with this. Okay, when he plotted, because you can't plot expected return, all you can do is plot average return, right? Expected return is a theoretical concept. Okay, so all you can do is measure average return of a security versus its estimated beta, right? And it's okay that it deviates around the SML because the SML is theoretical, right? The SML holds in infinite sample. Okay, so this is okay. But it says you should have as many positive deviations as negative deviations from the SML in your sample, okay, right? Okay, what Rolf Banz found was that there was an unusual pattern in these deviations. Is he found that stocks that were up here were disproportionately consist of small cap stocks. Okay, so in this cloud up here with high beta, but positive mispricing, if you will, those that had an expected return higher than their beta indicated they should have, these disproportionately consisted of small cap stocks. And these disproportionately, the rest of these down here, disproportionately, I guess maybe I should stick with this one area here. These down here, large cap stocks. Okay, do you understand what I'm saying here? So he found that the IBMs and the GM, GE, Apple, well, Apple didn't exist back then, but you know what I'm saying, right? We're down there. And then the little companies like Rocky Mountain Chocolate Factory, you know, the little things you've never heard of were up here, in general. You understand that point? Okay? And so what he did is he showed, this is very unusual, and he went on to show that this indicates that the CAPM, which this is a graph of the CAPM essentially. This SML is a graph of the CAPM, right? That's what he said. He basically concluded that since this cloud up here disproportionately consists of small cap stocks, which do have higher betas, by the way. Small cap stocks have higher betas, so you'll find it over to the right of the graph. But even controlling for their higher betas, they still have average returns that are too high for the CAPM. Right? You can see that, right, from the graph, right? Is that if what I'm drawing is what he found, the small caps have too high of expected return for the CAPM. The CAPM's not doing a good job of pricing these stocks, right? Right? And has too low of an expected return. I should say the large cap stocks have too low of an expected return compared to what they should pay under the CAPM, because the CAPM says they should pay on the SML. And again, it's okay to have random deviations, but this is strange when you have a cloud where there's a bunch of similar stocks. This gives you some pause that something's wrong with the model. Does everybody understand that concept? Or maybe you've seen this before. This is called the small cap anomaly, okay? Okay, so maybe this is still just review. But that's what he did. He did it through more or less an analysis like this, but in mathematics and statistical form, not in graphical form. Okay, so that was really an interesting thing. Another guy, Basu, 1983, found that the earnings to price ratio exhibited a similar mispricing. So these are disproportionately high E to P stocks, okay, which are value stocks. Okay? And these are disproportionately low P to E, or low E to P, which are high E to P, which are growth stocks. Okay, you'll notice that academics like E to P ratio, they don't like P to E ratio. Okay? They like E to P ratio because price can never be negative. A P to E ratio has problems because earnings can be negative. So we like to flip it so that the denominator can never be 0 and it can never be negative. That's why we like the E to P ratio. Okay? Okay? So, Basu found in 1983 that value stocks perform too high. So, question? Question? I'm happy to answer questions. It's okay. So disproportionately high E to P value stocks. Okay? High E to P stocks are value stocks. They're low P to E stocks. Same thing. Okay? Okay? Low E to P, same as high E to P, same as high P to E growth stocks. Okay? These are stocks that have blown up, like for example Apple. Right?
Actually, the small cap stock normally it has more growth option, so
they could be correlated. Yeah, they could be correlated with each other.
we expect that the small cap stock.
You know, this is the intuition I had. So he's talking about the interaction effect of small and growth. So we all kind of think that. This is my intuition too. Is that the really high growth stocks or small stocks that are startups and stuff like that? It turns out that the average small cap stock is a value stock, which is counterintuitive, but it's true. And the reason is because a lot of small cap stocks are companies that have fallen on bad times, and they become small cap from bad times. So there are a couple different types of small caps. One are the startups and the high growth ones, but there are more that are fallen angels. It used to be mid caps or large caps that have fallen in price. So it turns out the small cap and value outperform the CAPM. Right? Does everybody understand that? Okay. This is what they found anyway. And so this brought a lot of questions about whether the CAPM is actually a decent model or not. Okay. And there are a lot of questions. There were other tests as well. Ben Dory tested leverage and found that leverage helped explain future stock returns even after controlling for size and beta. Kine found that half of the size factor paid off in January. This is called the January effect. Okay? And Ryan Gennum is another paper that adds some more color to this thing. Okay, so that's just like a few examples, a handful of examples you must know if you're going to be, in finance. Is that everybody knows about these baseline studies. There have been about 500 to 1,000 studies done These are 4 or 5 of the most famous ones that you really need to know, okay? Commit to memory, because these, again, could be something that somebody would expect you to know in an interview, or could be in a CFA exam or things like that, okay? Okay, so here, the next thing here, I think you should spend some time reading 1.5, because these guys really were proving that the CAPM was wrong, but not necessarily that markets are inefficient. The two things are not the same, okay? The CAPM, for the CAPM to be correct, we said markets have to be efficient, right? Kind of perfect, right? But the CAPM can be wrong for a couple different reasons. First of all, that markets are inefficient. That could blow up the assumption, right? That could make the CAPM wrong. Secondly, that the CAPM is wrong because there's more than a single systematic risk influence out there. And maybe markets are efficient with respect to more than one or a different type of risk factor. Does that make sense? Then the CAPM is going to be wrong because a different efficient market holds, okay, if you will. And that's sort of the easiest way to think about this is a multi-factor efficient market, okay? Maybe 2 factors. Maybe we should have 2 factors. Maybe size is a second important risk factor, okay? Maybe we should have beta and size as 2 risk factors. Maybe we should also have value as a risk factor. And maybe if we put all 3 of those together, we might be able to have a set of securities that zeroes out around the SML in a 3-factor model. And this is exactly what Fama and French did, is they came up with this 3-factor model that was just exactly like that. Yeah.
Has there been research done to repeat the same thing for more reason?
Yes, yeah, great question. So the question is, has there been research done to repeat this on a more recent basis? Yes, and the more recent results seem to indicate that small cap pays off too low, not too high, right? The small caps have been very disappointing since the past 2 decades, I guess. Value continues to outperform growth, though, on the CAPM diagram, okay? So good question, but it still doesn't change the fact that the CAPM doesn't seem to fit the data very well. Okay, so again, it's good to reread. It's good to read 1.5 and think through this very carefully, because when I was an MBA student, I confused these things very, very much. I thought the CAPM was the only model that held if markets were efficient, and that's not true. It's just not true. Okay, it is one type of model for market efficiency. There could be other models for market efficiency. It all depends on how many factors are out there, how many risk factors are out there, how many systematic risk factors are out there. Okay, so Fama and French, so the next part, 1.6, goes into how Fama and French worked on this, okay? So Fama and French didn't do anything original in 1992. This is what this is talking about, is their 1992 Beta is Dead paper. Very famous paper. I don't even know what the real title of this paper is, but everybody in academia and in the investment world knows it as the Beta is Dead paper. Because this is the one where Fama and French killed the CAPM. They killed beta, okay? Forever, it seems like, okay? This was the big deal. 1992, this was a big paper, probably one of the biggest 5 papers in the last 40 or 50 years in financial economics, okay? So obviously you have to know this one too, okay? So I try to give you a simple depiction of what they did without getting into complications. That is a very long and complicated paper. But I tried to boil it down to just some simple paragraph or 2 with a graphic. Okay. So here's what they did. First, they estimated each stock's beta with 5 years or 60 months of past returns using a 1-factor grid. You guys have done that before, I'm sure. Just through OLS technique, you can do that in Excel for each stock. Okay. Then they ranked all the stocks by their market cap. Okay, which you can easily get from CRISP or from another database. You can even get it from Yahoo Finance, okay? You can get the market cap of equity. They ranked from largest to smallest, then they cut the ranked stocks into 10 groups. And on the graphic, here it is. The graphic shows this. They cut into 10, here are the biggest 10% stocks. These were like IBM, General Motors, General Electric, and so on, Apple. And these small guys are the tiny microcaps that you've never heard of, okay? for each of these stocks, they had betas computed, right? That was the first thing they did, right? Using 5 years of past return history, right? They then ranked, sub-ranked within this largest cap decile from highest beta to lowest beta. Can you see that? Okay? They repeated that for the second, the third, all the way down to the 10th. Okay? So they had this sub-segments and sub-segments, okay, if you will. They had a portfolio ranking within a portfolio ranking, a double sort, if you will. Then what they did, cleverly, is they took the highest beta stock from each of these 10 portfolios. I'm sorry, they took the highest 10% of beta stocks from this portfolio, and they put it into this thing called a high beta portfolio. They repeated that for the highest 10% beta stocks of portfolio 2, the slightly smaller stocks, all the way down to portfolio 10. They grabbed the highest 10% beta and they put them here. So here's where this one is, here's where this one comes from, right? Right? It shows where it came from, it shows where it came from, but they're all high beta. What have I done with that? Why did I do that? Why did Fallon French do that? They wanted to create a portfolio that had a high beta. What's wrong with this? I broke the. They wanted a portfolio that had a high beta, but had a mixed size distribution of stocks. Do you see that? They wanted to create a portfolio that had a high beta, but was mixed up with small caps, micro caps, big caps, mid caps, everything. All the caps they wanted to be heterogeneous in this high beta portfolio. They wanted to do the same thing with all the other beta ranked portfolios all the way down to the lowest beta. They wanted a low beta portfolio that had micro caps, small caps, mid caps, large caps, giant caps, etc. The idea here is they're trying to separate the influence of market cap from the influence of beta. Because as I said, if you don't do that, small cap stocks have higher betas. It's hard to see if small cap stocks are outperforming or underperforming, if it's because of their high beta or if it's because they're small cap. So you have to break these two things apart. And that's how they break them apart. Does that make sense? Anybody question is fine right here if you don't understand this. Okay? Okay. Then what they did is they took this portfolio and, they took this portfolio and computed the 7-year future return on this portfolio. And on this one, and on this one, and et cetera, down to the smallest. They had 10 portfolios here, right? Okay? They computed the 7-year future return of these 10 portfolios on the prior betas. So here you have an equal weighted beta of this portfolio, which is the biggest. Equal weighted portfolio, a beta of these, which is the smallest average beta, okay? They regressed the 7-year leading return, future return, on the value of the equal weighted betas cross-sectionally. That's just a 10x variable cross-sectional regression, saved the coefficient, okay? So they regressed return 1 to 7 years equals A plus B times size averaged, okay, at year 0 plus regression error term, okay. So this is a cross-sectional regression, okay. Okay? It's a cross-sectional regression here. Okay? And again, this should be I 1 through 7 years. Cross-sectional regression, they use the regression technique, cross-sectional regression technique, to see what the B hat was, right? The OLS B hat. The OLS B hat will be the best fit OLS regression coefficient that defines or describes the relationship between next 7 years return and current beta of the portfolio, right? Right? Right. I should have done beta, my mistake. Sorry, these are beta portfolios. My mistake, sorry to confuse you, okay? So essentially they found the coefficient of the beta, okay? How much did the beta explain the following 7 years worth of return? That's this guy. And they repeated this exercise for many, many months and many, many years, okay? And they averaged all those beta hats together, okay? So they have one beta hat for, you know, January 1963, another one for February 1963, and so on. They have just a whole lot of beta hats. Okay, all the way down to the end of their sample period, which was, I think, December 1989. Okay, so these are betas from a bunch of cross-sectional regressions. Does everybody understand that point? Where I'm regressing this on this, okay, where this is the average beta of each of the 10 decile portfolios. Okay, does everybody understand that construction of that series of these things? You step forward 1 month and do it again, step forward another month and do it again. So you have a bunch of betas now, okay, from different periods of time. And the last thing they do is they compute the average of all these betas, the time series average of all these betas, and the t-statistic for all these time series of betas. And what do you think they found? Well, you could read ahead. No significant relation. So they found that B hat, insignificant, and maybe even negative, but insignificant. Okay? Remember, it's supposed to be positive, right? Beta is supposed to positively forecast returns. They found that it might be slightly negative, but insignificantly different from zero. How did they get that result? They broke the correlation of size with beta. Okay? Then they went on this side of this graph and they formed the returns of the largest cap stocks with mixed levels of beta, etc., all the way down to the smallest. And here they found a very strong relationship. Okay? Here they found, and you can read it in the text below here, here they found that this, on average, over time, outperformed this on average over time. So they said, this means that market cap is a much stronger driver of return than beta is. Okay? They broke the relationship between the two. It's a really clever little simple test. Okay? Now they throw a lot of econometric tricks and techniques at this, but this in essence is what they did. Okay? And actually Eugene Fama, you know, he won the Nobel Prize a few years ago. He never really did any kind of really heavy theory or anything like that. Most of the stuff he did was just being brilliant with simple regression analysis, tests like that, and knowing how to do it properly, correcting for biases, all kinds of things. So he's like the most careful empirical researcher using simple techniques that I've ever seen in my life. Okay? And he won a Nobel Prize for that, along with some kind of high-level thinking about efficient markets and things like that, but he should get a lot of credit for it too. Okay? Okay? So they declared beta is dead because the left-hand side worked, the right-hand side didn't work. Beta is dead. Okay? It's size that matters, not beta, is what they said. Is everybody understanding this? So I'm giving you kind of a long story here, but the kind of the net of this should be that you understand beta doesn't seem to work in the US stock market. Okay, at least according to Fama and French. Instead, it's market capitalization that works as a risk factor. Okay? And they found that market cap used to be negatively correlated, maybe it's positively correlated now, but it does seem to be the risk factor that matters, according to Fama and French. Okay, so this was an incredibly powerful result, incredibly famous result that created a lot of uproar, a lot of debate in academia. A lot of people didn't believe these results. A lot of people, they got heavy criticism over these results, that they were doing things like data mining, that you know, that they weren't properly. So there've been a lot of papers that have criticized this and shown areas where this could be improved. Okay, but to be honest with you, 36 years later, this paper still stands out as a change in the way people think about risk factors in the U.S. stock market. People still think of this paper as kind of a big starting point, along with CAPM, but this paper sort of changed the conversation away from the CAPM and toward multi-factor models. Okay? Okay? So before this point in time, a lot of institutions were using multi-factor models, but there was no real nice academic theory behind it. And these guys sort of created the nice academic, not really a theory, but academic thought, I guess, behind this thing. Okay, so you can read through this. Other people, John Griffin did this on non-US, or global value, and found some certain things, okay? And a lot of people tested in other markets as well. People found that it was pretty, so all the stuff that I just did on size and beta, you could also do the same thing with value, E to P ratio and beta. You could cut them this way and see which one performs better in forecasting future returns. Is it beta or is it E to P ratio? Fama French did that too, and they found that it was E to P ratio. So their conclusion in their 1992 paper is that beta is a terrible metric for forecasting future returns. In other words, the CAPM doesn't work. The market portfolio is not a good risk factor, in other words, because beta is defined as a sensitivity to the market portfolio. So the market portfolio does not behave very well as a risk factor. What does better is two other risk factors: the market capitalization of it's not a risk factor, it's a sensitivity to a risk factor, the market capitalization of the stock, and the E to P ratio of the stock. Somehow those are sensitivities to two other risk factors that better explain the cross-section of returns than does the CAPM and its market return factor. Okay, so let me go on one more step here. So the one thing that they didn't quite find was this thing called momentum. Okay, so it's very powerful what they did. They found that this market cap and book to market, actually what they used is book to market ratio. They did not use earnings to price ratio. They used book to market ratio, which is book value of equity divided by market value of equity. Okay, they tried E to P ratio. They found that book to market worked better to predict stock returns than E to P ratio. So they decided to stick with this guy here. Okay. And so what they decided to do was come up with a three-factor model. And let me move ahead just a bit here to show you their. So here's the three-factor model that Fama French put forth after their 1992 and a follow-up 1993 paper. This is the thing called the famous three-factor Fama French model. And notice that it has the market return in it. And it has SMB, which is a risk factor that captures small stock minus big stock returns. And they have HML in this equation too, which is a risk factor that captures high book-to-market stock returns minus low book-to-market stock returns. So you get that HML, high minus low, small minus big, right? Return on the market minus risk-free. So these are all acronyms, abbreviations for an underlying factor, okay? You might ask, why do they still include the market portfolio when we said the beta doesn't work? It's actually something that I was confused with when I first thought about this for quite a while. So it turns out, it's in the reading here, it turns out that the reason for that is all these regression tests that Fama French did were cross-sectional tests. Okay, so they say the market the beta doesn't explain returns cross-sectionally, but the beta can still explain returns in a time series way, okay, when the market returns vary over time. So this is the thing you have to kind of get clear in your head, is that the Fama-French size and book to market experiments were done on a cross-sectional basis, across stocks, holding the market return constant, okay? And there they didn't find, they found no evidence that the beta matters. But going time series, now the market return is changing. So in essence, if you think about this a little bit, this means that you can basically replace beta in this equation with a 1. They basically, the beta doesn't matter, okay, is the outcome of this stuff. All right, you could replace this with 1 for all stocks and be pretty close to the right number. Now, they just let it be a free parameter, okay, and that's fine, but that's what they're saying, is that you should, your first impulse should be to assume that every stock has a beta of 1 in the marketplace. You can let this free parameter beta and let the data estimate that, but you should beware if the data tells you that the beta is a long ways away from 1, because we think it's close to 1. Okay? Okay? So it's a little bit of a nuance that you need to kind of understand, that it took me a long time to kind of formulate and understand myself. It's all in this chapter. Okay? Okay, so let's go to the last bit of distance here. One more factor to go, and then we can have lunch. Okay, still in chapter 1. Okay, 1.6.1. The one thing that Fama and French did not discover was momentum. Momentum in the stock market. And since then, this has become a very famous factor. And it turns out that I was sort of right in the middle of the discovery of this momentum factor. I was working as a research assistant when I was a PhD student, and one of the former PhD students had run some regressions incorrectly, and we stumbled upon this effect, this momentum effect. Now, I don't get any credit for it because I was a PhD student, and PhD students are 0, you know, in the world. So don't be a PhD student, okay? And the professors took off with this and got all the credit, but I didn't really discover it anyway. It was just like something that I worked on for a while, okay? Anyway, okay, so what does momentum mean to you? What does momentum mean to you? Momentum in security markets. Yeah.
When that thing tends to continue to move in the same direction that it has.
Correct. So when things continue to move in the same trend, over what time period though? And we could have like 1 minute momentum, 1 day momentum, 1 month momentum, 1 year momentum. What is the type of momentum that usually holds in stock markets? Something like that, 6 months to 1 year. 6 months to 1 year. Usually you find that if a stock has gone up a lot in 6 months to 1 year, it will continue to go up more on average, okay, over the next 6 months to 1 year. And again, on average, because there's a lot of error around that, okay? Okay? Stocks will go down over a 6 month to 1 year period, anomalous or analogously, continue on average to go down a little bit more over the next 6 months to 1. That's momentum. These trends continue trends continue, I guess is what I should say. Okay? So how is this tested? How was this discovered? A very simple thing that a high school student could do is these guys, this was a guy that I was the research assistant for, and when I worked on this mistake some other PhD student had made, it wasn't my mistake, by the way, a mistake some other PhD student used, or did, and I showed the results of this mistake, you know, then he realized the mistake actually uncovered this momentum thing. So it's a long story, so I won't bore you with that thing. So he ran down the hall, and he grabbed this guy, Jagadish, who was another faculty member at UCLA at the time, and they went and did a huge study of momentum in US stock returns, okay? And so what they did was a really simple, in their paper was a really simple test. They went to see, like this gentleman said, They wanted to see whether stocks that had gone up the most over the last 1 year tended to go up the most over the next 1 year, okay? And vice versa, down, down, okay? That is the essence of a momentum strategy, okay? And here are in the chapter are the graphs from the original paper. So here's what they did, is they went long an equal weighted portfolio of each stock that went up the most at month 0 over the past year, okay? They went long the 10% that went up the most over the past year as of time 0. They went short the portfolio of stocks, equal weighted, that went down the most over the past year, measured at month 0, okay? They then measured the long minus short portfolio return over the next 36 months, and here's what they found. Is they found a 1% rate of return, they found a slight negative return during month 1, then they found a series of fantastic returns, which equaled about 1% per month. Those are not annualized, those are per month. 1% per month for about 8 months, which are enormous returns for a long-short portfolio formed by a very simple rule, okay? And this graph is done not just with 1 month 0, it's done with lots of months 0. So this is averaged across a huge amount of time. I think it's let me scroll down, 1964 to 1989. 1965 to 1989. Okay? As they redid this every month, they found this is the average pattern. Okay? Which means momentum doesn't always show these patterns, but on average it does. Sometimes it does better, sometimes it does worse. Okay? And they found the T statistics were very compelling, that these were definitely not equal to 0, this long-short return. Okay? Now what's funny about that is that practitioners had known about this for quite some time. They had been using momentum strategies in their investment portfolios, professionals. And academics just refused to even try this because this was like a violation of weak form market efficiency, okay? Because this is technical analysis essentially. And Fama had convinced everybody, so Fama did a bunch of good stuff, but Fama did some bad stuff too. He convinced everybody that there's no way that you can make money off technical analysis, and this is indeed technical analysis. So the University of Chicago's point of view prevailed for so long that nobody even tried this, and finally somebody tried it and they found it works beyond belief, okay? And practitioners had always known this, that markets are not perfectly efficient like this, and that this thing actually exists, and so they were investing on this, and finally academics caught up to the practitioners, okay? So this says if you follow this strategy, this long-short strategy, that at least in theory, you can attain profits until they peak at around 9%, okay? Okay, by doing this strategy, and then maybe you sell the portfolio and you reconfigure, reconstitute it. But you know, it's like something a high school student could do, who had reasonable software skills and mathematical skills and things like that. It's not hard at all. So to most of us, this particular result was the biggest evidence in favor of inefficient markets that we could see from a long time ago till today. Because even today, momentum seems to pay off abnormal amounts. Now, some people see momentum as a risk factor, okay? So what I'm showing you here, it kind of looks like a inefficient market. It looks like something like money for free, almost, with a little bit of risk. Okay, but other people think that this is perhaps a risk factor because one of the chief illustrations or reasons behind this is because during the financial crisis, momentum lost a lot of money in just a very short amount of time. Within a few months, it lost 50% of your wealth if you invested in this long-short portfolio. So there's some disagreement about this, but in general, many people think this is perhaps a risk factor that is unexplored, like the Fama French size and book-to-market factors, okay? Other people think this is an anomaly. Myself, I don't know. I'm not sure. You know, I think it's an interesting factor, Is it a risk factor? Is it a evidence of inefficient markets? I don't know. I don't think the evidence is strong enough either way yet. So I haven't made up my mind. Okay. Okay, so after they established this, and they tested it over a couple of different time periods. They tested it from 1941 to 64. Here they found it worked again in a similar way, a little bit less well, but still generated that outperformance during the first 8 months. And then they did it again in the pre-World War II era. During the Depression, they found it didn't work. It had kind of the same type of pattern, but it didn't work well enough. It had a really bad first month return, and the thing never gets off the ground because it never gets high enough above zero. And the authors argued that this was a really strange period of time where the Fed was going back and forth between tightening monetary policy and loosening monetary policy so frequently that it was messing up all of the markets badly, and so they argue you should ignore this particular time period. Okay, I don't know if that's true, if you should ignore it, or if this is an evidence of that momentum has risks that expose themselves every so often. I'm not sure, but the authors, of course, wanted this to be an anomaly, so they said just ignore this time period and go forward with this. And this actually, so I think the one thing that everybody agreed with is that this momentum cannot be ignored. Okay, momentum in stock prices and other securities, as it turns out since then, cannot be ignored. But we'll stick with stock prices now. Even considering size and book to market, okay, or E to P ratio, momentum is still strong. So you can do this long-short portfolio I just showed you, and you can run a 3-factor model, and you'll find that that long-short portfolio exhibits alpha, significant alpha. So it's not correlated very highly with small cap or book to market ratio, okay? So most academics agree that there's something there. They just disagree with how to treat it, whether it should be treated as a systematic risk factor or whether it should be treated as a anomaly, a market anomaly that you can take advantage of and get free money, okay? You can believe what you want to believe, it's fine. But I think what people did, or what the thing that this led to, finally, was so Mark Carhart in 1997, remember that the momentum stuff, or the size and book to market stuff, was done in 1992-93 by Fama French. The momentum stuff was done in 1997 by 1993 also, by Jagdish and Titman. So Mark Carhart comes along, he's Eugene Fama's PhD student. He needs to write a thesis. And so what he does is he basically marries together this 3-factor model of Fama and French with a 4th factor, a momentum factor called UMD. Okay, so UMD means up minus down. Stocks that have gone up minus stocks that have gone down over the past 12 months. That's all UMD is. And Mark Carhart got kind of famous just by that one thing. Just by like taking 2 research papers and putting them together, like peanut butter and chocolate or something like that. Okay? And so now we call this the 4-factor model, or we call it the Carhart model. In fact, I helped to name it the Carhart model because I used it in some of my papers early on, and I started calling it the Carhart model. And now everybody calls it the Carhart model. I made this guy famous. And he's now running a hedge fund and making all kinds of money. So he's a really nice guy. Okay. So that is a very quick introduction to where we stand now in U.S. stock markets with risk modeling. Okay? The excess return on a stock or a portfolio can be expressed as its sensitivity to the market, its sensitivity to small cap stocks, its sensitivity to high book to market stocks, and its sensitivity to momentum stock returns, plus a mispricing component, if there is any, alpha, okay? That's what we call alpha, okay? And a random noise that generates a 0 average return, okay? This is like the state of the art. This is like the state, for the past 20 years, this has been the state of the art risk model in US equity markets. And then if you read on, you'll see that this, other people have done some work to see if this extends into non-US markets, and it turns out that it does a pretty good job in non-US markets too. Both developed and emerging markets. Emerging markets, it's a little bit more shaky, but it seems to work pretty well around the world, okay? The only caveat being that when you choose these factors, if you're gonna run this in Japan, you need to use a Japanese SMB, a Japanese HML, Japanese UMD, and so on, okay? So each region needs to have its own factors, okay? Okay, so here I ran so let's take a look at this applied, okay, to a particular stock, okay? So I ran a 4-factor regression. That was for that same stock that I did earlier with the CAPM, Chevron, okay? And I ran this 4-factor model above, and here are the results I got from OLS for a 2-year period of return, 2-year periods of return, 2009 and 2010. If you remember, I did that back in table 1.5 of this chapter. What I found is that Chevron has a beta close to 1. This is exactly what Fama French would have theorized, right? Because this is what they said, is beta really doesn't matter. You can treat them all like they're 1. It has a negative size exposure. And of course, that makes sense because Chevron's a big cap stock, so it has negative exposure to small. It has essentially 0 exposure to value growth, high book to market minus low book to market. So it's basically a neutral stock, at least as of this point in time. And it had a significant exposure to momentum, which means the Chevron stock had gone up over the past 12 months and was acting like a momentum stock. So I can tell a lot of stuff about this stock from this simple OLS regression, just using data on the stock, the factors, and the coefficient output. I can find a lot of stuff about the stock. I can tell you, even if you didn't tell me this was Chevron, I can tell you this is a large cap stock with momentum. I can at least tell you that. That seems to be neither growth nor value, right? And it's kind of an important thing to understand is that regression analysis, it can tell you a lot of stuff, you know, without knowing anything about what's going on with the underlying asset or portfolio. You can reverse engineer a lot of stuff from regression analysis, okay? And this will hold true, especially when we assess the portfolio performance of mutual funds and other active managers using this model. We're going to get a chance to dig into that data soon, okay? Okay, so let's see what else we have. So you can stop there. Yeah, you can stop there. You can stop before the stock characteristic-based model. This is a model that we worked on. My advisor worked on it, and then I worked on another paper with him, and we laid out how to apply this to price stocks as well. You can kind of stop here. I think the main thing to understand is the 4-factor model, how it was discovered, what it means about stock returns. It means that this doesn't work, okay, by itself, okay? You need to have like 4 dimensions of risk, of systematic risk, not 1 dimension. 4 dimensions of systematic risk, okay? The market, market cap, value growth, and momentum contrarian. 4 systematic risk factors. That's what people more or less think today about the US stock market. And if you miss some of those risk factors, you're going to get bad results for the ones you actually put in there. Okay. Bond returns. So Fama French 1993 also did some work on bonds, and they surprisingly found that the stock market return and the stock market size factor and the stock market value factor did some explanation of bond returns too, okay? In addition to a bond market term structure risk factor and a bond market default risk premium. So why might the stock market spill over into the bond market? Why might the risk of the stock market spill over into the bond market? Maybe the fund flows, yeah. Maybe fund flows. Maybe they hold common, yeah, maybe flows come out of flight to safety, things like that.
Yield on yield differential between the two asset classes.
Right, okay, so yield seeking or something like that, okay? Okay, relative yield seeking, which is a little bit related to this. How about, yeah?
That's the portfolio risk. What is the instrument to adjust the risk of portfolio?
So, okay, because of the portfolio effect or something like that. How about corporate bonds? Wouldn't you expect those to be, corporate bonds to be sensitive to the stock market? Because a corporate bond has exposure to the risk of the corporation, right? Yeah, so there's some of that too. And the corporate bonds have a beta exposure to the stock market through the fact that in a recession, corporate bond investors do worse, right? They lose money on their portfolio. Yeah. Okay. The beta on corporate bonds is not very big, but it's there. It's positive. Okay. So it turns out that a set of fairly simple risk factors can be used for the bond markets too. And what else do I do here? Yeah. So then I say here's what Froment and French's 1993 results say could be used for a 5-factor model that would be used in bond markets. They would use the stock market factor, the small minus big stock market factor, the high minus low stock market factor. Notice there's no momentum in bond markets, so we drop that factor, but there's a term and a default spread factor in there. Okay, so ends chapter 1. So we got through what we needed to get through this morning. Time for questions. Yes, sir. Yeah. Sure.
The reason there's no momentum is because it's tested enough.
Yeah, the reason there's no momentum, great question. The reason there's no momentum in bond markets is because when they tested for momentum, they just didn't find any. Bonds that went up over the last 12 months just don't seem to go up, over the next 12 months. So whatever happens in the stock market doesn't seem to spill into the bond market for whatever reason.
What about the yield itself?
That's what they tested. They tested the yield would have responded if there was momentum. The yield would have dropped, right? But it did. It did, at least on a 1-year basis.
What about on a longer? The yield
Maybe.
curve is sort of. The yield itself is sort of momentum if you look at it in a longer period of time. Right?
Oh, you're talking about the upward sloping term structure?
Well,
or
not
the yield
the
curve?
structure, but just as in the 10-year.
What about it?
The yield, the trend of the yield itself, if you look at it for a long period of time, you see it's over past 20 years.
Yeah, but that's a time effect. What I'm talking about here is a cross-sectional effect. Yeah, right? I'm trying to discriminate between different bond returns. You're talking about a time systematic effect, which is different. So other questions? Other questions? Okay, so study hard the chapter and problems that you're assigned for the quiz on Tuesday, and let's come back after lunch and hit hard on chapter 3, okay? Okay.
Well,